So if there's two Starbucks baristas married to each other, they can actually afford a brand new 2023, 24 built townhome with 3 beds, 2.5 baths, 1 car garage, and a small backyard, and amenities around the community. And that is not possible for 96, 97% of America.
Yeah.
Oddly
I'm only
enough,
interested in the
that
remaining
60
3%.
oddly enough, that 63,000 is the same amount you would need if you live in a New York City high-rise condominium for Christmas tips.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the professor, Luigi Rosabianca. What's on tap today, Lou?
Matt, we're going to have some fun. Today we have the mad scientist of multifamily, Neal Bawa, who happens to be a technologist. I'm going to have to do a deeper dive on that a little bit later. And a data scientist as one of the most sought after speakers in commercial real estate. Neal, welcome to the podcast. Thank you so much for joining us.
Well, thanks for having me on the Liquid Lunch. I look forward to some interesting conversations.
Oh, you will. I'm looking forward to finding out what a technologist is, sir.
Oh, I mean, I'm a tech guy, right? So
Okay.
I think that's just a fancy word for a tech guy. Computer science degree, data science is my background. Ran a tech company in Silicon Valley. I live in Silicon Valley. From 1999 to 2013, sold it to a private equity firm. And because I was making, I had the big fat tech salary and I lived in Taxifornia, I was paying, 50% of my salary to the IRS. Felt at times that I was working for the IRS.
Thank you for your contribution, sir. We really appreciate it.
Yeah, yes. No, I'm not very happy about that. But what I did was I fell backwards into real estate because I discovered the wonders of depreciation. Not for other investors, but just for myself. And when you're paying 50% of your salary to the man, you're looking for ways out, and real estate basically just happened to be my way out. So I fell into it by accident.
Fascinating. So a technologist, you can go into any field, programming, software, IT. Instead, you landed on bricks.
It's all about profit. So I'll tell you this. So when we worked in technology, right, and I worked in technology both in India at a very large company, 27,000 employees, and also worked here in one company in the US. One of the key things is that in technology, firstly, you have these ultra smart people, much smarter than me, that are willing to be like Elon Musk. Elon regularly is the richest man in the world, regularly works 100-hour weeks. Not every single week, but most weeks he's, somewhere between 80 and 100 hours a week. And that is a philosophy in the tech community that you can't just work smart, you've got to work hard. So that entire industry, if you are basically competing with other people in tech, those guys are working 80 to 100 hours, and some, startups are working 120 hours a week. And if you want to work a 40-hour work-life balance sort of thing, that's just not really possible in tech because they leave you behind. If somebody else is working 100 hours, you're working 40, guess who's going to win? And so I think work-life balance is a real challenge in technology, and also specifically in Silicon Valley. So it's really, really bad in Silicon Valley. There's lots and lots of people that get 4 hours of sleep. And so at some point, so I did the whole thing with tech. I did the whole 100 hours a week for a decade, and then eventually it starts to wear on you. The other challenge is what I mentioned before, which is I was making a lot of money, but not keeping a lot of money. And as you get, older, you get a little bit smarter about keeping the money, and that's really what drew me into real estate. And even then, my move into real estate was accidental. It was not planned.
Tell us, how did that happen? What was the brainchild?
So it's 2003. My tech company is making a lot of money, and the senior partner, I was the junior partner in the company, basically said, we're not going to be landlords. Sorry, we're not going to be tenants. I don't want to be a tenant. I want to pay myself. I have a great business, and I want to basically pay rent to myself because I know I'm going to be here 20 years from now, right? So why should I pay rent to other people? And I was like, great idea, Paul. And he's like, okay, let's go build a campus. And I said, great idea, Paul. And he said, okay, and you will build it. I said, no, that's a shit idea, Paul. I mean, I don't know anything about real estate, right? I mean, what you know a lot about this kind of stuff, and what we did it eventually did it collaboratively. He did a lot of the architectural design work, and I did a lot of the measuring, the measurements, and things like that. So we built our first campus. We started work on it early 2003 and moved into it on July 4th, 2004, which also was my son's birthday, and I spent my son's birthday with my son helping me move. Um, and so we moved into this campus, and all of a sudden, my take-home salary increased greatly. So there were no investors, there was no bank. It was just all of our cash. We made a billion mistakes, like a billion, right? But we were okay because we didn't have any investors or bank to talk to, and made our own mistakes and sucked it up. But then I realized that all of a sudden I was making a lot more money if I was only looking at post-tax salary. And since then, I never ever look at my pre-tax salary. I'm only interested in my post-tax salary. I've just stopped looking at the top line number, right? This is just like companies. You've got entrepreneurs. I tell entrepreneurs, don't look at your revenue, don't look at your gross margin, look at your
Okay.
net margin, right? Start with the net margin, start with the bottom line, and then go backwards, and you'll have a much more profitable company. And so I was doing that for myself. I was my one person company where I'm like, how do I improve my bottom line, my net margin? And I learned that depreciation is incredible in doing that, especially if you're the limited partner and the general partner. It's much better if you're both. Uh, and so I ended up building six more campuses, or building or improving six more campuses over the next 10 years. And then in 2013, when I sold my company, I had a shockingly large tax, multi-million dollar tax event. And so I go to my CPA and I say, hey, how do I, and I'd been doing real estate for myself over the previous 5 or 6 years, very deeply involved. And I'll tell you that story. Like, thousands of people were following me at this point. And I went to my CPA and I said, you know, I have this huge tax bill. Is there any legal way to get rid of it? And he said, yes. You need to do something known as a syndication, where you buy this building, but you don't put 100% of the money in. I know you have lots of money right now. Don't put 100% of your money in. Maybe put 25% of your money in, or 20%, and the remaining 80% of equity, get it from other people. And I said, why is that beneficial? He said, well, in that case, you as the general partner, you as the limited partner, you obviously get depreciation for the piece that you invested, but you also as a general partner get a piece of their depreciation, the limited partners. So now you can buy four buildings and split your money across it and get 2 or 3 times the depreciation that you would get by yourself. And I was very intrigued by that idea, never heard of the word syndication before, went and studied it. No chat GPT back then, so I had to do web searches and talk to people. And so ended up, buying a 237 unit building. And because for the previous 5 years, I had just been doing free real estate, distributing my real estate data science, we were able to sell it out in a day. In a single day, we were able to sell it out to people that for 5 years had been following my real estate data science,
Nice.
which is sort of a halfway between real estate and technology thing that we were doing for free for 5 years. And that's what got me in there. So I think if that taxable event hadn't happened, even though I knew about the benefits of real estate, I wouldn't have gone into real estate.
Yeah, depreciation is a major. So if you ask my kids, right, why do we invest in stocks? They're going to tell you appreciation. Why do we invest in real estate? Cash flow and depreciation is the biggest benefit there,
Depreciation.
right?
Yeah.
So I drill that into
Though
their head.
I have to say that that was true. As of 2026, there's very little cash flow in real estate that
I
I can
know. Right
find
there.
anywhere. There's a little bit here, a little bit there, but I think the biggest benefit today is depreciation and future cash flow.
Okay. I could see that.
So I usually say future cash flow.
So what types of asset classes do you look at when you're buying or these days?
You know, I am a sponge. I like to study everything. So I study all kinds of commercial asset classes, and I also study single family real estate. I study single family because I basically tell people the entire commercial asset class, especially multifamily, is basically a subset of single family. Single family is the largest asset class in the world, not just in the US, it's in the world, of any kind, right? It's larger than the stock market. So if you take the worldwide stock market and you look at the worldwide single family market, the single family market's larger, right? So it's a very large market. So it's important to study that market because it affects everything that we do in commercial. And on the commercial side, I study multifamily, self-storage, retail. I study senior housing. I study student housing, um, and office. office used to be the biggest asset class on the commercial side. Now it's apartments. So obviously apartments have been the biggest focus that I've had, but I have built flex industrial. I have built office. I have built I built retail. Um, and I have built a large student housing facility. I bought many of these different kinds of assets. I bought a self-storage and then built more self-storage. So I like to dabble in all of them, but my core is multifamily. And think of multifamily as basically a whole bunch of single families together.
So you said build, right? So I'm assuming, do you take the Sam Zell model where you're not the first person to be in the property, you're buying it after, or you build from the ground up? What do you like better?
So when I got in, I was not confident enough about my building capabilities. Remember, I'd built 6 campuses, but none of them were apartments. So I didn't really know how to build apartments. So I didn't have the competency or the skill or the confidence to go out and start becoming a developer myself. So I started out like many other people have, where we would basically buy buildings that were built in the 70s or 80s or 90s, and then we would basically go and rehab and improve them, spend about how you guys do single family rehabs, we do, and they might be $100,000 or even $500,000. In our case, we spend somewhere between 6,500, that was about 12 years ago, to today about $12,000 a unit, and we rehab them. And our goal is to raise rents by $150 to $175. And if we can raise rents of each unit by 150 to 175, we can typically double investor money in 5 years, or close to double, not quite double, but close to double investor money in 5 years. So that's the basic apartment rehab 5-year business plan. And then, of course, I have gone on to build, lots and lots of large apartment projects and other kinds of projects as well.
Do you stay geographically focused in one area?
Well, I'm glad you asked me that question. So remember when I told you that for 5 years before I took investor money in 2014, 2014 is the first time I took investor money. For 5 years, I was doing heavy real estate. I was doing it as a hobby. So I had this big business with large conference rooms. And in 2009, I became obsessed with real estate from a depreciation perspective because I'd been gathering lots of money because I wasn't paying taxes, right? So I was gathering lots of money. Timing was incredible, right? Everyone else around me was telling me that this was the worst time in history to buy real estate. But as a data scientist, when I gathered data from hundreds of different sources and put it into a software, the answer that came out was, this is the best time in history to buy real estate. So I could not understand why everyone else thought that I was the biggest idiot of all time, because I would go around telling people this is the greatest time in all time to buy real estate, and people would look at me like I was a moron. And so I said, okay, I need to find people like me to look at what I'm doing with this data set. I use a statistical analysis software. In our industry, it's called R, just R. And everyone in the industry knows what it is. But basically, it's a software that gives you trend lines. And the trend was telling me that real estate can only either go up or go up like very fast. And it turns out, of course, in hindsight, that it went up very fast from that 2009, 2010 point. And so I'm like, I need to find other people like me. So I came up with an idea. There was a new company.com that had opened up called meetup.com, and you could go there and basically create your own meetups. And so I created a meetup around real estate data analytics. I gave it a really awful shit name and later on improved it and called it Location Magic. But basically, we said the purpose of this meetup is to rank every city and every metro in the US for real estate investment. Which ones are the best, which ones are the worst, and what really matters. That was our goal. That was all we cared about. And so the first time I did the meetup in 2009, 4 people showed up. But 2 of them worked for Apple. 1 of them worked for LinkedIn. 1 of them worked for HP. So these were all rich guys that had lots of money. And that meetup, normally meetups last 2 hours, that meetup lasted 6 hours because we were so fascinated with what we were doing. We were spidering data from dozens of different websites, doing some stuff that may not be, maybe a little shady, and putting this information into this database and comparing cities. The second time I did the meetup, I had 10 people. The third time I did it, I had 100 people. And so my brand now, there's about 75,000 people that follow me. And those 75,000 people know me as the mad scientist of multifamily. And what they know me for best, and that's where I come back to your question, is a ranking of cities. So I rank cities in the United States. We rank 1,016 cities, 293 metros. And each year, we don't typically talk about every single one of those metros. A lot of them are just pretty awful. But we every year bubble up about 50 metros in the US, 50 metros or cities that are really good for real estate. And then we explain why. And our webinars throughout the year, about 20,000 people sign up for them every year. Our webinars are around that concept. There's a lot of different things that we do. We do webinars outside of single family and multifamily. We do webinars for AI. We do webinars for climate change. But the core focus is ranking cities. So the short answer is I have not focused on any one city or state. My portfolio is in 17 cities in 10 states.
Okay.
And it's a roughly 660 million right now, sort of goes up and down. At some point it was a billion, it's gone down now because multifamily values have gone down. It's about 1,300 investors.
Neal, what are some of the cities that we would be surprised to hear are on your top lists?
Plenty. I mean, I think that, people hear about, the big cities, but they don't hear that what they don't realize that the money is really in the smaller cities. So you would be very surprised to hear that one of the cities I think is the best in the US is Idaho Falls, Idaho. You'd be surprised to hear that Northwest Arkansas, which is a cluster of 5 cities, is at the top of my list. You'd be surprised to hear that Reno is more powerful than Las Vegas. You'd be surprised to hear that I have no California cities in my list at the current time, nothing in New York either. So I think that places like Greenville, South Carolina are an incredible place to invest in. Raleigh, which is actually fairly well known, is a terrific city to invest in, but the city next to Raleigh called Durham is actually better. So to me, what I find is everyone knows that, all these big cities in California and the coasts are great for real estate investment, but they're not. They're not, because when you compare them to cities one level below them, they're nowhere close. Boise, Idaho is an incredible city to invest in. I don't think Los Angeles or San Francisco Bay Area, where I live, are great to invest in. In fact, did you know the San Francisco Bay Area has lost 4.2% in home prices in the last 12 months? Nobody knows. Nobody cares. Well, it's San Francisco. It'll get it back. Yeah, but that's not investing. That's you saying, I'll just sit on stuff and wait it out. That's not a data-driven investor. That's just you saying, well, I didn't do my homework, but I'm stubborn, so I'll just sit on it for 10 or 15 years and it'll come back up. I mean, on an inflation-adjusted basis, you lost a lot of money, right? So my group, the people that follow me, are interested in understanding where these cities and what matters. Why is Northwest Arkansas better than, let's say, Little Rock in Arkansas, which is not a market that I like at all. It's in the southern half of Arkansas, and how to compare cities. Like you guys, the two of you are sitting, and one of you says, I think Grand Rapids, Michigan is a great city. And the other one says, no, Grand Rapids is really shit. I think Indianapolis is better. Well, how do you compare those two? Right. We've created a system that compares it.
Well, what are those metrics? Is it population diversity? Is it
Sure.
Is it GDP of cities? Like what are the metrics that you're looking at?
Sure. So we've looked at dozens and dozens of metrics. So we have a course on udemy.com. So if you type in UDEMY, udemy.com is a very popular website. There are millions of courses. So udemy.com space my name, Neal Bawa, you'll find the course. It's called Location Magic. And that course currently has 15,000 students, and it has 1,000 5-star reviews. And the course basically goes through all of these metrics. I'll give you the short version because it's a podcast, but the course actually takes you through it with an Excel spreadsheet with all the details, right? And we have an updated version of that course. You can't update the courses on Udemy very often. So the updated version of the course, which I would highly recommend everybody take, is on a free website called Multifamily University. There's no subscription, there's no fee. You just go there and take the course. It's called Location Magic, Multifamily University. We looked at dozens of metrics, and some of them you just mentioned, but we weren't interested in looking at dozens of metrics. We wanted something that was really simple, takes 5 to 10 minutes, and gets us 90% of the way there, instead of basically spending thousands of dollars on gathering data. I wanted something free, like anyone on the web can go find this stuff by themselves without me being involved. And so I had to build a system that was extremely simple to use and worked universally without you ever buying data from me, because I wanted to be like the Wikipedia of real estate data science. Nobody ever pays anything for Wikipedia, right? So The 5 things that make the biggest difference are population growth, job growth, home price growth, income growth, and crime reduction. These 5 make the biggest difference. Yes, schools make a difference. Yes, the GDP makes a difference. Yes, what the local politicians are doing make a difference. But I wasn't after everything that made a difference. I was after what makes the biggest amount of difference and creates the simplest system that anyone can use without me. And that was those 5, right? Population growth, home price growth, income growth, job growth, and crime reduction. The catch, though, is for each of those 5, there are specific numbers and ranges. Got it? So you can't just say Indianapolis is an awesome city because it's got job growth and it's got population growth. Yes, but so do 700 other cities in the United States. So that's not an argument, right? The question is how much population growth, how much job growth, how much income growth, are there minimum benchmarks, and what's a sweet spot, right? For example, for job growth, the sweet spot is 2%, anything over 2%. And most cities in the US don't grow at 2% job growth, right? For income growth, there's a particular number. For population growth, you need to be around 0.9 to 1% population growth each year. Why is this stuff important? Because when the population grows faster than a certain level, right, you start sucking basically your occupancy becomes high, your vacancy becomes low, and rent growth accelerates. But you need a certain amount or certain percentage of population for that frenzy to happen. I like going to cities where the frenzy hasn't happened yet, right? Northwest Arkansas, rents are still somewhere around 10, 1100 in Northwest Arkansas. It's sort of median rents. Whereas in other markets with the same income, they're 1500. So Northwest Arkansas is an anomaly. Idaho Falls, rents are 1200, but Idaho Falls is a lot richer than markets like San Antonio or Houston or Dallas, right? So their incomes are a lot much higher. Their rents are much lower. So they're in an unusual situation where there's this dichotomy and there's no glass ceiling. The rents can keep going up because people have incomes. That's what I'm after. I'm trying to find places where job growth is amazing, incomes are high, but rents are low. So I can go in there and understand that over the next X number of years, call it 5, at some point there'll be a break. At some point, their occupancy will go above 95, 96, 97%. And at that point, every apartment owner will raise rents. And that one single year of high rent growth, call it 10% rent growth, meets my 5-year business plan. Because remember, to double investor money, I only need to raise rents by $175. I don't need to double them.
With these locations, have you noticed a political trend on whether they're blue or red or purple?
Yeah, predominantly they're red. So what I'm finding is it's much harder to make money. I live in obviously a blue state, and I live in a very blue part of a blue state. And I'm finding that it is across the board true that it's very difficult to make money. You can actually get good appreciation in blue states, but it's almost impossible to get any cash flow. With red state, you can get some cash flow and good appreciation, and your overall risk level is lower because you're not paying a shockingly high amount for the property. Like I'll give you an example. This is a
Please.
perfect example. During COVID, I built brand new townhomes in Idaho Falls. Brand new, 3-bed, 2.5 bath, 1-car garage in the front, a small, backyard, 9-foot ceilings, granite countertops, LED lighting. Very nice, right? I mean, this is a great townhome that people would want to live in. 3-bedroom, 2.5 bath, 2 floors. So the project was highly profitable and very, heavy cash flow. And my tenants, even after 3 years of living in there, are still only paying $1,770 on average per month, which is $21,000 a year. So if you make $63,000 in income as a family, you qualify and you're not rent burdened because only 1/3 of your income is going towards rent. 63,000 in Idaho Falls is 2 Starbucks baristas. So if there's 2 Starbucks baristas married to each other, they can actually afford a brand new 2023-24 built townhome with 3 beds, 2.5 baths, 1-car garage, and a small backyard, and amenities around the community. And that is not possible for 96, 97% of America.
Oddly
I'm only
enough,
interested in the
that
remaining
60
3%.
oddly enough, that 63,000 is the same amount you would need if you live in a New York City high-rise condominium for Christmas tips.
Or in San Francisco, where average rents on one bedroom are somewhere in the $3,900 range,
Yeah.
right? So, I mean, what I'm finding is housing is broken in about 95% of the United States. We have
But Neil, what you're
337 million
saying is
people.
so refreshing. But the underlying theme is if you're a young professional, what you need to do is vote with your feet.
You very much should. So one of the key things is that I am finding that we are seeing a slow migration where the young generation, especially the millennials, also Gen Z, are beginning to understand that basically the baby boomers screwed them over, and their generation will never be homeowners if they don't vote with their feet. They're beginning to understand that. And what's really helping them is technology, because more and more of these people are working in jobs where they have to go into the office, once or twice a week. The other thing that technology is doing is, if you look 30 years ago, tech was concentrated in Northern California. Silicon Valley was, like where $6 or $7 out of 10 would go in on new tech. It's still number one, but now there's 30 technology centers in the United States and growing. There's 30 of them, right? So now a lot of these young people that tend to be focused on, technology and white collar jobs can go to a lot of different places. Where do you want to go? My idea, Boise, Idaho. Boise is a metro hitting 1 million. It's one of the fastest growing in the United States. Idaho, by the way, is one of the fastest growing states in the US. You can simply type in, go to ChatGPT and say, use the U-Haul survey and tell me what states in the US are fastest growing. You'll immediately see South Carolina, Idaho at the top of the list, Utah. So most people don't know this information. They don't realize that there's states, and these are mostly red states, that are fast growing, right? So when you go to Boise, you'll still get fairly reasonable rents, but there's employers fighting over you, right? So you probably walk in there and get 3 job interviews in your first 2 weeks. And that's not going to happen in California, right? You're going to spend 6 months trying to get those 3 job interviews because there's so much competition. So I think Gen Z millennials are figuring out that previous generations basically broke the dream of homeownership and wealth building for them. And the only way to get around that is to vote with their feet.
So I left New York City and then I moved to Orlando. For the price that I sold my townhouse for in New York City, I have a 5,000 square foot house in Orlando. My townhouse for 1,300 square feet, But this is back in 2015. Okay. So
Matt,
Yeah, and
imagine
remember
what you
now
can do.
now you couldn't buy that house
No,
if you moved
no.
today. So because that 5,000 square foot house in Orlando just in the last 10 years has more than doubled, might even have tripled,
Yeah.
right? So when values go up, the problem is you have to keep moving down. Orlando was one of those great cities that you moved to in 2014 and you had an incredible life.
Yeah.
And now in 2026, Orlando's getting expensive or starting to get expensive, where it's like, oh my God, this isn't making sense anymore. So really every 12 to 15 years, you have to step another level. The cities that I'm talking about, Reno, Northwest Arkansas, Greenville, South Carolina, Idaho Falls, Kansas City, Indianapolis, they are the next step.
Yeah. Greenville, South Carolina has a lot of banks there. It's a big banking hub too. So there's a lot of jobs in that area.
Yep, 500,000 people, well, 1 million person if you include the metro next to it, right? Because there's 2 metros of 500,000 people each. We look for metros that are 500,000 to 1 million people. And occasionally we'll make exceptions, like Idaho Falls is only 200,000 people, but Idaho Falls is unique in that, have you either one of you heard in the last 12 months the word nuclear
yeah.
over and over again as part of our obviously AI requires a shockingly large amount of energy. The only way to really get that energy over the next 20 years is to bring nuclear back, correct?
Yes.
Yes.
The only place in the United States to certify nuclear plants happens to be Idaho National Labs. One place in the United States. So they have a shockingly high number of PhDs going in there. So whether it's Jeff Bezos's nuclear company or it's Bill Gates's nuclear company or the one that Google is backing, every one of those companies has to build locations at Idaho National Labs so that they can test their reactors. So I have a special reason why I'm going into Idaho Falls.
I like that. I'm
right?
Okay.
So sometimes there's a unique reason to go into a city that cannot be replicated. I mean, it would take us another 30 years to build another Idaho National Labs, and nobody's even trying, right? People are just like, oh, you're a nuclear company? We just go to Idaho Falls, right? That's the answer. Everyone has to go. There's no real choice.
Neal, I'm curious, have you any metrics on gauging where retirees and seniors are moving to in the States?
Um, Generally not, unless I'm building senior housing. So if you're building senior housing, it is important to track those metrics. Obviously, Florida still continues to be number one in terms of count or numbers, but may not be number one anymore in terms of percentages, right? So sometimes a small state can beat a big state in percentages. So in terms of percentages, there are like people are moving to Wyoming because Wyoming has great weather and lots of nature. So we've seen a huge move for people moving to Wyoming. In numbers, they're small. In percentages, it beats Florida. But still, at this point, Florida continues to be unquestionably number one for people that are moving there. Yes, there are people moving back, but if enough people are moving there and some people are moving back, it doesn't change the situation. Florida is still number one. Otherwise, I love to look at U-Haul data. So for the last 10 years, my most popular presentation, which is watched by about 10,000 people, I always bring the U-Haul data in. The U-Haul data usually comes in at the beginning of the year, so like second week of the year, third week of the year. So I do my presentation in the fourth week of January because I like to have access to U-Haul data. And I'm beginning to see changes. So obviously Texas, Florida still up there in the list, as two big states. But now I'm beginning to see South Carolina, Idaho, Utah sort of, take over. And last year, for the first time, the state with the highest in-migration was South Carolina. Utah has been winning before. Texas and Florida still usually in the top 5, but they're just no longer the magnets that they used to be.
Do you think that's
Neal,
because of the price of housing in those markets?
Yes.
Okay.
And property taxes.
Yeah.
So when you're living in these states, the property taxes are crazy.
Well, in Florida, DeSantis is talking about if this happens, I think Florida's real estate's going to explode.
Well, if what DeSantis does, it's revolutionary. Yeah. I think Florida would get a 20-year boost if he does that. Now, how he's going to make the numbers work is a different question. Yeah. But if he's able to pull it off, it would be truly disruptive for Florida's real estate market because it's beginning to suffer. As you know, in Miami, especially the condo market has completely crashed. Yeah. And basically is illiquid. You can't really sell your condo. Some of it had to do with that building that that collapsed, and since then the condo homeowners fees went completely insane, and so people are trying to sell those things. But Miami in general is in a bad place, and so he's got to do something.
Mm-hmm. Miami is a special animal, right? I was just down there last weekend. It's a special place.
It's extraordinarily unique, right?
I think Dallas is now the financial capital of the world. I don't think New York City is anymore, or it will be in the next 10 years. Miami is going to be a close second, right? I think
Miami is always going to be unique because enough ultra rich people have moved there. So at the same time, we have a situation where the condo market is crashing, home prices are not going up, but ultra luxury home prices in Miami are going up 10, 20% a year. Mm-hmm. So Miami is becoming like our Dubai. Dubai is obviously the most unique city in the world, but Miami is becoming our Dubai.
Yes.
And which is sort of a unique sort of thing. And so it has this one benefit, just like Silicon Valley. I always have belief in Silicon Valley because we've got incredible universities and we've got incredible tech. And so that sort of keeps our home prices from going down, even though they're crazily high, right? The median home price in my county, the median, right? 50% more, 50% less is $1.3 million, right? That's median, right? And they go all the way up to $50 million.
It's insane. What are your, there's a problem right now with insurance in California and Florida and even Luigi, we were just speaking about this, the increases are 25 to 30%. How do you see that affecting?
It's stunning. People? So the short answer is Californians are so rich at this point and have so much equity that they're basically sucking it up. But
you become self-insured.
Really
at that point, you become self-insured. It doesn't pay to pay those. Well,
premiums. You can self-insure if you have debt. So as far as I know, so I have 11 rentals in California, and I have my single-family home. So 8 years ago, my single-family home was $1,000 a year. I'm currently paying $3,300. So in 8 years, it has more than tripled. Wow. So gone from 1,000 to 3,300. Same thing for all of my rentals. I still keep my rentals in California because I've depreciated them. If I sold them right now, I would be paying a lot in taxes, so I'm trapped. So I keep 11 of my rentals, and I can tell you that the the insurance situation in California is going to turn into a crisis and get worse and worse every year. It's just it's a phenomenally bad situation. California does have one huge benefit. We passed a proposition 4 decades ago, which keeps our real estate taxes low as a percentage of home prices. So compared to, let's say, Texas, my real estate taxes are very high. I'm paying $23,000 a year. But when I compare that to the value of my home, they're pretty low.
Neal, thank you so much for being here. We want to be respectful of your time. Why don't you tell the audience, we know about Udemy already, but where they can follow you and they can learn more about your meeting that's coming up in the last week of January, I believe.
Sure. So my name's Neal Bawa, and firstly, I'm the only Neal Bawa on the web. So if you read good stuff, so that's one way to search for me. Just my first name, last name. There's nobody else. So if you see anything bad, it's probably about me. The other the other thing is multifamily university. So we believe in creating groups of people that are like-minded. So if you're data-driven or you want to be data-driven, come to Multifamily University. You'll get information on single family and everything in multifamily, everything in commercial. 8 times a year we do webinars. About 20,000 people sign up for those and watch them. And we have no subscription, no upsell, no premier tier. It's just an open community for people. And if you're wondering, how's that a business model? The answer is 1% of our database ends up becoming investors with us. And the remaining 99%, they get it for free. So it's a freemium model.
I love it. Hey, Neal, I got one question before I let you run. What's one thing right now that nobody's paying attention to that could disrupt this market in the next 6 to 12 months?
I'll answer the question from a 24-month perspective, and the answer is artificial intelligence. AI is the single greatest and the single most dangerous technology ever invented by mankind. Imagine the level of fear that you felt about nukes when you were living through the 60s, 70s, and 80s. Now imagine something 10 times more dangerous. And you're still not imagining AI because you need to imagine something that's 100 times more dangerous. Artificial intelligence is mankind's greatest achievement and its greatest threat. In 2 years, we will start significant job loss, but at the same time, we will see skyrocketing stock markets. So imagine a stock market that gets higher and higher, and imagine layoffs that get faster and faster in 24 months.
So from that perspective, stop buying assets.
I don't think that that's going to happen because essentially there's going to be a little bit of a crash there in terms of buying assets, but you would want to keep buying assets because the stock market is going to keep going up. When the stock market goes up, it creates a wealth effect for the rich, and those rich tend to buy assets. So the evidence actually is that when stock markets go up, people tend to buy all kinds of assets because they feel rich.
Mm-hmm. Neal, thank you so much. Everybody, that's a wrap. The Liquid Lunch Project. We'll catch you on the next episode.
Let's go!